Hello everyone! Welcome back to the channel for another video regarding the stock market. Today, I want to talk about investing overall. Many people talk about dollar cost averaging into the SPY or Vanguard funds such as VOOG. I wanted to do an analysis of what it would look like if you dollar cost averaged into the SPY starting in 2018 all the way until now. If you were to buy one share of SPY each week, at the end of the week, this is the result that you would have had as an investment account. So looking at this chart, you can see the x-axis is just in numbers. These numbers would represent each week and also would represent the number of shares purchased, since in this model you are purchasing one share per week. You can see that you would have accumulated 285 shares, and likewise it would have taken that many weeks for this study. So just over 5 years, how did we do? Well, you would have invested just over $100,000 into the SPY. The account value, if you were to sell all of your shares right now, would be just over $120,000, which means you would have a profit of around $20,000. You can get these numbers from the left-hand side axis, which is going to correspond with the orange line, the total account value, and the blue line, or the principal of your investment. On the right-hand side, you will see a percentage axis, which will correspond with the gray line, which is your percent profit and loss for the account. We can see the account is up around 20% according to this chart. Considering $20,000 profit on a $100,000 is in fact 20%, so it all checks out. Now a little bit of analysis of this chart. You can see during the stock market peak around December of 2021, the account was closer to 40% up. Also, number of months later, you can see the account traded down to nearly the principal investment around the 233rd week. This can be visualized anytime the orange line gets very close to the blue line, which would also represent a 0% profit or your current shares equaling your basis cost. Considering these two extremes where your account is up 40% and then nearly up 0% or even worse negative, I think some thought should be put into investment strategies which allow for some discretionary timing or hedging to the portfolio to smooth overall profit and loss. For example, if you did not want to sell your shares and then try to get back into the market, you could simply write calls against your shares. Perhaps a good strategy would be, when your account is at a relative new all-time high profit, sell some Delta 20 calls and that 45-day cycle to receive some premium just in case the market falls. Of course, this will put you at risk of selling your shares, selling them at a higher price from when you initially sold the call option. I would consider that a very high-quality problem to have. The other consideration when dealing with DCA strategies is the amount of capital you have at risk at the time. This is a substantial amount of principal risk the individual is taking if you are simply going to be long-only stock. It may seem rare that we ever have any sort of market correction these days, due to what the reckless fiscal spending of our government, which continues to prop up the stock market, but sell-off can happen. If that was to happen in this account, the overall value could very quickly become negative if we were to have a repeat of last year. Of course, these scenarios could also be offset by layering on option strategies to protect from downside risk, but that is a discussion for another day. Let me know in the comments section below what you think about dollar cost averaging and if it is really worth its merit. Thank you. Have a great day.